Hello and welcome to this video series I'm creating on financial management for dental clinic owners. My name is Mohammed Ismail. I'm the founder and CEO of Shift Accounting. We specialize in providing bookkeeping and advisory services to dental clinics across Canada. If you have not watched my first video regarding a P&L, I would suggest that you go back and watch that video first, because today I'm going to be speaking about cash flow statements and how this document is very crucial to dental offices, and specifically dental offices who are struggling with cash flow. Okay, so the report that I'm going to be sharing today will be a continuation and will be, kind of referencing back the P&L that, I mentioned in the previous video. Okay, so a cash flow statement is an important document because what it does, it shows if a clinic is producing a positive cash flow or a negative cash flow in a specific period. Now, why I like the cash flow statement is because, number one, it shows any timing differences. Okay, and we're going to speak about that in this video. It also shows things that doesn't show up in the P&L. As an example, loan payments, dividends or shareholder loan. All of these items would, show up in a cash flow statement. Now, depending on the accounting software, your bookkeeper or accountant is using, your cash flow statement might look, slightly different. Okay. Sometimes it will look very similar to a P&L with, some adjustments. I kind of like these types of reports. But in this example, I'm showing you a condensed version of a cash flow statement from a high level. And honestly, the most important part would be the bottom of the report to show if the clinic is actually generating a positive cash flow or not. Okay. So in the example that I'm sharing with you today, the cash flow statement would have three important sections. One is the operating activities. So think about your AR, think about all the, payments to wages, your suppliers, all of that would be under the operating activity. Okay. Then investment activities. So think about purchasing equipment, payments that you made for equipment. And then financing activities is think about your bank loan, maybe a line of credit, and a shareholder loan. Okay. So in this report, again, it's continuation of what we've been working on. Okay. So in this example, okay, this hypothetical clinic generated $127,000 of net income. Okay, where did we get that number from? That number came from this report, okay, and that's why I was referencing the other video. So we have 127,000 in net income, okay. Now, once we factor in multiple things, so think about did all of the AR was received, okay? Did we pay all the bills, and when did they get paid? All of these factor into the cash flow statement, okay? Additionally, equipment, let's say we purchase equipment throughout the year, that would show up in the cash flow statement. Let's say, in my example for the P&L, I'm making the assumption that the owner dentist received associate fee, okay? So that is the example that I'm, referencing here. So this is already was part of the calculation, calculating the net income. But we can see that the owner of this clinic, in addition to the associate, fee that he or she got paid, they took an additional $50,000. Okay. Then we have a loan payment, okay, of $10,909 per month. So that is factoring into the cash flow statement. So now, once we factor all of these items in this hypothetical scenario that we have, this clinic generated a negative cash flow of $224,000. Okay, so A, disaster. Okay, B, you could see that the two reports are very different. So let's go back to the P&L. Okay, so the P&L. Okay, when we look at the production for this clinic per month. Okay, it's not bad, okay, in terms of production. profitability of this clinic. We're looking at 7.9% in profitability, really at the low end, but at least on paper the clinic shows that it is a profitable clinic, right? We're not seeing losses, and we're factoring, as I mentioned, we're factoring the doctor pay or owner's associate pay already in this scenario. So why do we, when we look at the cash flow statement, it shows us a completely different scenario, and again, I look at it as this is a disaster scenario. Okay, well, let's think about why would we be in this situation. Okay, so number one, the P&L again is showing production, not collection, right? So does this clinic have AR issues that maybe they're not collecting their production? That's possible. Why would we have this big cash discrepancy? Okay. Number two, finance activities. Okay, look at this. There's $130,000 loan payments. This is only principal. Okay, loan payments going towards the loan, right? So only if you look at assuming everything was received from AR. So we received $127,000 in net income, and assuming the timing, there was no timing difference. So that means every dollar that we collected, we received. Every bill that we had, we paid it in that same month. We should have $127,000 in the bank. But $130,000 is just going towards paying the loan. So that's right there, issue number one. We bought equipment, additional equipment of $20,000 during the year, and then the owner took an additional $50,000. So that now we have a negative $224,000 of cash flow. So this is a very important report that you should be looking at and asking your accountant or bookkeeper to provide that report for you on a monthly basis if your cash situation is dire, right? This would be an important report to look at. Okay. In the next video, I'm going to create strategies and show you some strategies to alleviate this pressure, cash flow pressure, and show you some strategies to improve profitability and cash flow. Thank you very much.